Ladies and gentlemen, and welcome to an alert webinar that I actually wouldn't like to run this morning, but considering the global circumstances, we have decided to run this webinar because it will be some time before we run some of our face-to-face meetings. Those face-to-face ones are coming this week in Geneva and in Zurich, but also I think it will be too far to wait until May and June when we run meetings in other locations in Europe, as you can see here on the list. Times are challenging with the new tariff laws and tariff wars, and here are some of the questions that I will be covering this morning. There will be issues on what will these Trump tariffs mean for the global economy and Europe? What will they mean for Middle East, Africa, and CIS markets? What is the actual purpose of the new Trump tariffs, and what are some of the other policies that might be coming up? And I would like to also make a comparison with 1930s and see if we can learn anything from history. And then look at the impact on commodity prices, interest rates, currencies across EMEA, and then also some guidance and advice to all of you multinationals how to handle all of this. Now, I wanted to make some jokes about penguins, but in fact, I don't think nothing's funny anymore. I will go through some of the issues line by line, and just wanted to say also, don't worry if you don't catch everything that I'll be talking about, because we are recording this webinar, and we will send you the recording, and you can share it with your colleagues in your corporations. Also, on Monday, you will receive a comprehensive extra paper that will summarize things that I will be sharing today and add a few more points as they develop during this week as well. So there will be plenty of ways for you to double check and hear again what I was saying. And we have enough time, by the way. We allocated 90 minutes, but we probably will need a bit more. I assume there will be many questions. I can see now almost 500 participants in the webinar, and people are still coming in. So in case there are questions, don't worry, we have enough time to address all of your questions, and we can extend it easily by half an hour if need be. Also, if any of you would like to chat one-on-one with me later on, we can always find time next week and set up one-on-one sessions. And also for your teams, as usual, we remain always available for all of our members for any in-house presentations or any further insights that we can share, sometimes only one-on-one. Now, you remember back in October, I usually write a global paper that is forward-looking. And in that paper, you have probably picked up on a sentence which said, the biggest threat to the global economy in 2025 would be the election of Donald Trump. And then I quoted all sorts of risks that could happen if he gets elected. In a paper in November in 2024, 3 days after he was elected, I also wrote a paper and sent it to all of the members, where I highlighted, based on his pre-election promises, all the risks that could happen to the global economy and your business. And I hope you read that paper. If you haven't seen it, you can always order it from Christian Daimo. And you can take a look at some of those risks that I highlighted. I hope this was a timely warning, because we were always convinced that tariffs would come. And as you know, in many of our country reports, we are writing at the beginning always, we are assuming tariffs will come, and this has been feeding our forecasts already since November last year. Now, what's happening at the moment is also, of course, extremely concerning. But I think before I go into some of the key reasons why I think they are doing this, it is good to look back and step back into a little bit of history. In 1928, on the back of supporting agriculture, the Republicans won the Senate, the Congress, and Hoover became president. Agro-lobbies were pushing to be protected against rising imports of food and agro products. When industrial lobbies realized that Republicans were keen on protecting the agro-lobbies, what they also started to do was to lobby the US senators and congressmen and the Republican Party to be protected as well. Two senators were appointed, one called Smoot and the other one Hawley, to come up with a new tariff law. Smoot, by the way, was a polygamist priest from Utah, of all places. These two gentlemen were coordinating an effort to add as many industrial and agro products to the tariff list of the products that will be protected under the new Tariff Act. This passed the Congress and the Senate, and then the stock market crashed in October 1929, marking the start of the Great Depression. And yet, this didn't stop the Republicans from pushing through the tariff law, and it ended up on President Hoover's desk in early 1930 for signature. Henry Ford went to the White House, and in his biography he wrote, "I went to the White House and I begged the president not to sign off on quote-unquote economic stupidity." Thomas Lamont, who was at the time the CEO of JP Morgan, he went to the White House, and in his biography he writes, "Well, I was literally on my knees begging the president not to sign off on it because there are so many domestic and foreign debtors who will be hurt by tariffs, and they will not be able to pay their debts to the American banks, which could bring the whole system down eventually." And yet Hoover, who was a geologist by training, he worked in mines before becoming president, he signs off on this tariff document in June 1930, and it becomes law. Within days, all trading partners retaliated, all European markets, Japan, Australia, Canada, Mexico, anybody who was trading at the time with the United States immediately retaliated. By the spring of 1934, 4 years later, global trade went down 66%. US GDP within that 4-year period fell by 36%. Unemployment in the United States went from 5% to 25%. Several thousand American banks went under. Many banking failures in Europe as well, setting flammable preconditions for the Second World War as well. And yet these trade wars simply continued during the early 1930s and created and certainly made a massive contribution to the Great Depression at the time. That was, by the way, not the only reason for the Great Depression. The global system was different than it is today, and I will elaborate on this in the paper that you will see on Monday. But for time reasons, I'm not going to go into that detail yet. But the key takeaway here is that tariffs of this magnitude, and by the way, Smoot-Hawley tariff act was only 19.7% tariff, and in this particular case with Trump now we are already at the average of around 25, the highest in more than 100 years. This is always a disruption. Usually what happens historically when you introduce tariffs of this magnitude, global trade falls, global economic activity falls, manufacturing recessions typically, supply chain blockages as well, and the biggest issue, of course, is uncertainty. And private sector doesn't like uncertainty. Households don't like to buy. Also, investments by companies are usually put on hold until there is more visibility. And if governments can sometimes help overall demand, maybe that can help. But in this particular case, many countries today are highly leveraged already and have limited ability to increase spending if the private sector freezes and doesn't spend properly. So this is a historic lesson, which I think is very important for you to keep in mind. There are many tools, by the way, at the moment that central banks have, and governments as well, that would most likely prevent another Great Depression. but we could still end up in a very unpleasant recession. And also at the same time, potentially another global financial crisis that would be similar to 2009. I will come to this a little bit later in a moment. Now, let me just also summarize what all these retaliatory tariffs all about. And I'm not going to dwell too much on it. It's been a lot said about it, but just the key main points. It was signed in February. And during my speeches, and many of you have heard me speak in February and March at our meetings in Europe and in Dubai, for the benefit of you who have not heard me speak in the last 2 months about the retaliatory tariffs, I'll just repeat a few points here. This, for me, was immediately the biggest risk of all the tariff threats, because it was all-encompassing. It was talking about all countries. And it not only didn't talk about equalizing tariffs that other countries are imposing on the US. The executive order also said if the US doesn't like certain regulations, certain taxes, certain non-tariff barriers, even values, and VAT, for example, all of these things would be added to the so-called retaliatory tariff, and some figures will come up. And when we looked at the figures that were presented in the Rose Garden in the White House, when Trump was holding that poster with all the tariffs, he was trying to come out as a generous man, saying they are ripping us off, but we are imposing lower import duties on others than they're imposing on them. I am generous, he said. Then we checked the figures for Europe, for example. He was holding there and said, on Europe, is actually ripping off the United States of America with a 39% import tariff on average, when the truth is only 3%. I have no idea how they came up with 39, but they probably took into account VAT, maybe some regulations they don't like on AI or social media or financial services, but number was floated as 39, nothing to do with reality. In fact, Europe is running a trade deficit in services with the US, and the current account between the two mega powers economically is actually zero. No one's ripping off anybody. Europe has an advantage in goods trade, but US has an advantage in services trade, and yet it was still hit by a 20% tariff altogether. It didn't make much sense at all. And no wonder some of the mainstream politicians in Europe now believe in perhaps other more sinister agenda that might be behind the imposition of a 20% import duty, and more on that in paper as well. Now, the big important question is, are these retaliatory tariffs actually more dangerous for the health of the global economy than the Smoot-Hawley Tariff Act of the 1930s? And the answer, I'm afraid, is actually yes, especially if key trading partners decide to retaliate. In the same way, there was a retaliation in the 1930s, and China is already doing it. And I will explain why in a moment. But if we look at why this could be more dangerous, for example, US imports as a percentage of US GDP are now actually 3 times larger than they were in the 1930s. And global trade as a share of global GDP is now around 58%. And in the 1920s, it was only 9%. So the world is much more interconnected, many interdependencies, many issues in terms of interconnections on the supply chains, many countries dependent on each other for trade, supplies, raw materials, components. All of these things could result in a significant freezing of the economic activity that would actually surpass what was happening in the 1930s when global trade fell 66%. And yet, despite the markets crashing, and even as of this morning, bond markets are crashing, not only stocks, as everybody is rushing to cash and gold in this madness of economic policy, yet they seem to be persisting that this will simply continue. Now, what I'd like to do now is tell you why they seem to be persisting with all of this, despite markets' backlash And even many Republicans now and the billionaires who funded Trump, they are even saying this is wrong and needs to be reversed. There are many documents that are floating around in the Trump administration that can offer some guidelines in terms of why they are doing all of this. But I think one document actually stands out. And so far, everything that has happened and everything that seems to be happening as we speak today is actually largely based on that one document. And I will go through some of the issues here in that document in particular, because it did look that it was all random, that all these tariffs were just, they came up with this bizarre formula calculating in a peculiar way how much each country is going to be affected. But there is actually a system in the background and the ultimate number of goals. The paper actually comes from the chairman of the US Council of Economic Advisors, Stephen Miran, who actually reports directly to the president. He's a Harvard-educated PhD, an economist whose mentor, by the way, was Martin Feldstein, who was at the time the chairman of the same institution, US Council of Economic Advisors. And he was there running that same council under Reagan. Feldstein was there under Reagan, and now one of his pupils, Miran, has the same position under Trump. So a lot of what he has been writing is now being implemented. And it's a fairly technical document, macroeconomically as well, and he's not a particularly good writer either. So deciphering all of this, what I'm doing for you today, and you will see this in the paper, I actually reduced all this macroeconomic technical speak to 20 points, which I will go through now for you. And they will explain how they see things. What is the policy behind all of this? And the reasoning. And the main points that Miran is putting forward, and this is obviously fully supported and endorsed by Trump and a few other people that are surrounding him, like Navarro or Scott Bessent, the Treasury Secretary as well. So what are some of these points? These 20 points, I summarized it for you. Point number one, Trump administration will undertake a substantial overhaul of the international trade and financial systems. US has many levers to do that overhaul for its own benefit, and will do so without hesitation. The path to the overhaul is narrow, they admit, and they carry substantial risk of economic and market volatility, but it is claimed in that document that it is still worth doing for the medium to long-term benefit of the US economy and the US geopolitical power. It also adds that US should use the fact that it is a holder of the world reserve currency, and it should use that fact to exert its will in foreign, trade, and security policies. That's point number one. That's where they're coming from. This is important to understand. Point number two they're making. Well, first of all, my quick comment on point number one, but watch for the recession risk here. It's quite significant. And they admit the path is narrow to achieve the overhaul of the global financial and trade systems. The second point is they claim the dollar is overvalued and the US will push to bring its value down, but not immediately. The dollar is overvalued, they claim, because there is demand for it by other nations that buy it to build and preserve their dollarized forex reserves. The dollar also tends to strengthen during global recessions, they say, because of its appeal as a safe reserve asset, which then hurts US exports. And therefore, overvalued dollar is bad for the United States because it weighs heavily on the US manufacturing sector, making exports less competitive and making imports cheaper. Macroeconomic analysis, and this is my comment, shows that the US dollar is indeed overvalued. But that's not the reason why, most likely. The reason why is that US continues to run a sizable current account deficit. It simply continues to import too much relative to its exports. So the fact that others are buying dollars for forex reserves is only one of the reasons. That's just a quick comment on the sideline. Point number 3. Despite the desire of the Trump administration to weaken the dollar later on, and I will tell you in a moment what the plan is there, the US should strive to keep the dollar as the world's reserve currency and should punish countries that switch away from the dollar for trade. Well, good luck with that, I can say, considering that if you try to weaken the dollar, you will also diminish the desire for it. So how can you keep it then as the world's reserve currency is my quick comment on that. But that's what they say. Point number 4. US runs a current account deficit every year for decades, not because it imports too much, but it imports too much because it exports treasury bills to other nations so they can maintain and build their dollarized forex reserves. In my view, this argument is actually upside down, but at least that's the thinking. Point number 5. Since US tariffs and tariff-related policies will reduce imports to the United States, they will help increase exports and they will narrow the current account deficit. Therefore, the dollar would then temporarily strengthen. Theoretically, that's correct, but will exports actually increase considering the tariff wars? That's the flaw in the argument, in my view. In their view, the US purchasing power would not be affected then, because US would collect more tariff revenues, while citizens of countries selling into the US become poorer, as their currencies temporarily weaken against the dollar. And therefore, the conclusion that Miran makes is that countries that exports to the US ultimately pay the price or bear the burden of higher US tariffs. Point 6. Other nations are taking advantage of America in both defense and trade at the same time. Therefore, the defense umbrella and the US trade deficits are linked through the US currency. Point number 7 they make. US GDP is growing slower than the world GDP. Therefore, US national power, geopolitical power, is decreasing steadily, and this must be reversed. Point number 8 they're making. US inflation rate did not rise when Trump introduced new tariffs in 2018 and 2019 because the dollar got stronger as a result. And the argument goes that the new US Tariff Act will also temporarily strengthen the dollar, which will then eliminate or offset upward inflationary pressures stemming from new tariffs. Don't worry again if you didn't catch all of this. All of this is being recorded and it will be repeated in the paper as well. But see, the argument they're making is that simply dollar will get stronger as tariffs kick in, and therefore that will eliminate inflationary pressures in the US, so prices would not rise in their view in the US. As long as they keep doing it, simply it would not go up, which, by the way, has many flaws in that argument. Point number 9 they're making is that US has generously lowered its tariffs to help the rest of the world rebuild after the Second World War, or to create Cold War alliances, but other countries have taken advantage of the United States. Point 10. The new tariffs and the future dollar policy are aimed at improving competitiveness of US manufacturing, preventing new offshoring of manufacturing, creating more manufacturing jobs in the US, but mostly focusing on higher value added manufacturing coming to the US rather than very low value added like textiles, for example. Point 11. New tariffs will increase negotiating leverage, and this is very important. New tariffs will increase negotiating leverage that will enable US to force other countries to open their markets to US exports and do a few other things which I will come a little bit later. Point number 12. The round of tariffs introduced on China during the first Trump term forced China to lower the value of its currency, leading to lower Chinese purchasing power, which means this made China weaker, and China effectively paid for the tariffs. Point 13. They say that China is by far the biggest geopolitical threat to the United States, far bigger than Russia. And the end of history, as Francis Fukuyama argued, has not really happened. Geopolitical threats from adversaries, chief one being China, have risen beyond anything US could have imagined back in the early 1990s. Point 14. US manufacturing, including importantly defense manufacturing, is too dependent on production in other countries, including components, raw materials coming from China. Therefore, to increase its national security and power, the US must build everything it needs at home and not be dependent on any foreign nation or some fickle international supply chains that depend on perhaps untrustworthy foreign nations. Point 15. Allies which depend on the US to defend them should share a far bigger burden on defense. Point 16. US budget deficit is too high, on 7% of GDP, while public debt is ballooning, so therefore new revenues from tariffs will help plug the budget gap. Point 17. VAT in countries around the world is a form of a trade barrier because, quote unquote, because they exempt exported goods but tax imported goods. By the way, this goes contrary to the WTO ruling of the 1990s, when WTO said VAT cannot be seen as a trade barrier because at the end of the day, everybody pays for it. Point 18. A sudden shock as a reaction to new tariffs can result in financial market volatility. But Miran argues that Trump deeply cares about financial markets and that he would take steps to ensure large structural changes to the International Trade Code occur in ways that are minimally disruptive to markets and the economy. That's not, by the way, what we are seeing. We're not seeing graduality in here. And then there's a peculiar point as well, point number 19. And I'm not sure what kind of science this is based on. And there are some quotes from scientific papers as well that argue this point. Point 19 says this: as long as tariffs do not exceed 20%, they will actually boost aggregate welfare of the United States. But if they do exceed 20%, they become welfare reducing to the US. And then the worrying point is this: but if countries retaliate, this will impose additional costs on the US as global trade breaks down. Retaliatory tariffs by other nations can nullify the welfare benefits of tariffs to the US. The conclusion then follows, and I quote, preventing retaliation will be of great importance. And this is why Trump threatened additional tariffs on those countries that dare to retaliate against the United States. US would also, they argue, reduce its security umbrella for any market that dares to retaliate. That includes EU, Japan, South Korea, perhaps a few GCC nations as well, if they dare to retaliate. And then point number 20, finally, if countries dare to retaliate, they admit in this document, everybody will be damaged, but the US will be damaged less than other markets, which goes back, I think, to a book that I quoted in my recent speeches from Professor Hirschman called National Power, written back in the 1940s and published in 1945. A good one to read, all of you should do it. And it argues very forcefully how big countries that dominate economic space can bully the small ones and damage them more than they're damaging themselves. Now, all of these 20 points, my take on this is that considering everything they're doing at the moment, they are just following that blueprint. And these seem to be very deep beliefs, and nothing, it seems to me, will derail their implementation, even if some changes bring temporary turmoil uh, to US and global stock markets. And basically, all of this seems to be designed to increase US geopolitical and national power, which Trump and his followers believe is rapidly being eroded, particularly by the rise of China. Now, the next point I would like to share with you, or a few points, is the following. So how are these policies being implemented, and how will some of these policies be implemented in the future? First point, the new retaliatory tariffs, in my view, are the primary starting tool to begin with that reshaping of the global trade and financial system for the benefit of the United States. Interestingly, no country aside from Russia, Belarus, North Korea, and Cuba has been spared, by the way, from new tariffs. Now, this analysis from Iran, where he says, well, the dollar will strengthen temporarily, and therefore US inflation will not rise, the calculation he is showing is that actually inflation rate in the US, following all of these tariffs, the highest in more than 100 years, would increase US inflation rate by only up to 0.6%. And that means that that means that Trump will not eliminate tariffs until he gets concessions from every trading partner. This is a big takeaway here. They know they want to also bring those tariffs below 20% on average, because they claim welfare enhancing in the US, that will be the case. And these talks with many nations, including many in Asia, from Japan, Vietnam, India, anybody else, EU in particular, we are now going to talk with the US to try and make concessions to the United States. While this process is going on in the coming months, it will be very disruptive still to global markets because there won't be any immediate clarity on this. But still, that's a big takeaway. The whole idea is to actually force other countries to start begging the US and then start making concessions in line with what they already set up as a big plan. The second point is that since tariffs will strengthen the US dollar temporarily, I still question whether they will, US exporters will then have a temporary challenge of the strong dollar when selling abroad, they claim. But to help firms cope with the upcoming issues, the Trump administration is already telling companies in America to start hedging. But, and this is where we go back to economic history again, Miran says that the solution to the temporary lack of competitiveness of US exports due to that stronger dollar at the beginning is actually massive deregulation and tax cuts. He argues that deregulation and tax cuts are a solution to fight against any inflationary expectations as well. So they're not going to stop the idea of massive deregulation, whether it's financial services, IT, AI, whatever the deregulation is, it's likely to happen. And at the same time, tax cuts in America will also happen as well. In an interview, by the way, Stephen Miran on April the 4th, he argued the following, and I quote, "Regulatory environment is critical for the supply side of the economy. If prices are high and rising because there is not enough stuff, the best way to address it is to let firms make more stuff by getting the government out of the way, letting firms invest, build, and produce. If you let firms produce more stuff, inflation rate will not rise, it might actually fall." And then he went on to argue that deregulation and tax cuts will have a bigger impact on prices, pushing them down, than tariffs pushing them up. In other words, what they're trying to say is despite tariffs, the totality of Trump's administration economic policies, upcoming big deregulation and tax cuts, would also keep inflation rate under control, and this also includes creating energy abundance that would push energy costs lower. The counter argument to this is, what if the dollar doesn't strengthen temporarily? US consumers will then face higher prices and higher tariffs will be borne by them, but the administration seems to be still taking the risk. What this is, by the way, describing, and I think this is a third point in terms of what's coming up in terms of the implementation, in addition to starting trade talks with so many countries. But also, I think this is economic supply side economics more than anything, because the recipe for economic growth is this. Higher tariffs will lead to higher revenue for the US government. This then enables the government to do tax cuts, which will then produce an economic boom boosted by deregulation. And ultimately, stock markets will recognize this, that deregulation and tax cuts will be bringing the US economy to boom again. And therefore, stock markets will recover thanks to that economic boom. Now, all of this, by the way, my dear friends and colleagues, is the return to the so-called supply-side economics of the Ronald Reagan era. And it was championed by Miran's mentor, Feldstein. The difference, by the way, in supply-side economics is about all managing the supply side rather than demand of the economic story, which has still today shown to be a wrong economic policy, in my view. But they're still pushing for it. And interestingly, if they want to make a comparison with Reagan, there is a difference between Ronald Reagan and Trump, because Reagan was a free trader. And I found an interesting quote from him. He said, he also, by the way, liked immigration. And Reagan said, the freer the flow of world trade, the stronger the tides of human progress and peace among nations. But now we have the worst of the supply side economics combined with 19th century protectionism and also xenophobia against immigrants as well, combined in this unusual package. Also, point number 4. What will these negotiations with other countries actually force them to do? As US is trying to get them to do whatever US wants them to do. So US will want them to appreciate their currencies, buy more US products, reduce tariffs and non-tariff barriers for US exports, reduce unwanted regulations, reduce subsidies and any other tax they don't like, remove regulations for US financial services, force trade partners to buy more US weapons, energy and agro products, and bring new manufacturing investments to the United States. Those countries that are not willing to make deals, according to Miran, will be punished by higher US tariffs, by threat of US withdrawing financial assistance from them, or US withdrawing the security umbrella for such countries, and maybe in some other ways there would be punishments as well. And Miran seems to be enjoying Trump's approach that deliberately creates uncertainty over whether, when, and how big tariffs will be, which creates fear and doubt, which then creates extra leverage for the US in any upcoming negotiations with all of the countries. Scott Bessent, the US Treasury Secretary, has even argued that countries should be put in different groups based on how they treat the US product, what their currency policy is, what their values are, I'm not sure what he is referring to here, and what their security arrangements might be. And each country, based on this criteria, would then be subject to different tariffs. And if countries do as the US says, countries can earn their place in a group that is subject to lower tariffs. This way, the US would create additional negotiating leverage for incentivizing better terms for the US, both for trade and security arrangements. And there's a whole list of questions which you will see in the paper when I send it over to you that they will be asking countries to do. And what are the things they're looking at in these upcoming negotiations? And they will make it really tough, I think, for many countries to negotiate deals that would be acceptable to them. Now, on China, and I think this is where I already in the October paper, I sent several pages of analysis why the US and China global trade war and the Cold War will only get worse. But here the point is the following. 5th point, in terms of implementation. From the US geopolitical perspective, high tariffs on China are desired and inevitable. Miran argues that high tariffs on Chinese product would cause significant market volatility in China, pushing domestic economic participants to find ways to take money out of China around the existing capital controls. And they argue that capital outflows from China would then lead to asset price collapse in China and the severe financial stress within China. And since China is labeled as the biggest geopolitical threat to the United States, they argue, therefore, it is of utmost importance for the US to try to create an economic and financial crisis within China, which I guess would ultimately provoke social unrest, provoke the fall of the Communist Party, and then eliminate the threat of China to the world order that the US has been running since the Second World War. So, considering that these two administrations are so wide apart and that each other seems see the other side as ultimate enemy, Cold War trade wars will continue. There is no question about that. And they also say that China does not deserve any mercy here, no sympathy, because it breached the first phase of the agreement during the first Trump term, and therefore China cannot be trusted at all. Now, the other point is this point about trying to push the value of the dollar down. This is also another important item here to keep in mind. Now, the idea here is that once the initial tariff shock is over, in which the dollar would temporarily strengthen, they argue, they say after that, and I presume the plan would be 2026, there would be a deliberate plan to push the value of the US dollar down. But for that, they admit they would need the coordination of other countries. And this would be similar, I guess, to the Plaza Accords of the 1985, when US, Japan, Germany, France, UK did a coordinated action to weaken the dollar. It was agreed that this would be beneficial for everybody at the time, which, by the way, then had to be another accord called the Louvre Accord in 1987, when the dollar fell too much and they had to intervene in the other direction. In other words, what they're trying to do is they will try to convince countries to help them weaken the dollar. And if countries do not agree to weaken the dollar, they would be subject to punitive tariffs, or they will lose their security umbrella that the US has been providing, or countries would even be taxed for holding US dollar reserves. Or they even said there would be a threat of US not paying interest on some of the US bonds as well, to try and get the countries to comply with a joint intervention to weaken the US dollar. I told you at the beginning why they argue the US dollar is overvalued. Now, this coordination effort could be called the Mar-de-Lago Accord. That's been floated already, but I'm trying to explain here to you what this actually means. What they're trying to achieve is that weaker dollar would then help US exporters, while stronger currencies of other nations would absorb more US exports. US here will then target those markets that hold sizable dollarized reserves and say to them, spend those reserves and help us weaken the dollar. And by the way, who holds most of the dollarized Forex reserves are some of the big Asian markets and the wealthiest markets in the Middle East, in the Gulf. In fact, aggregate the sovereign wealth funds and Forex reserves of the key markets in the Middle East, you come to over $4 trillion. And US now seems to be planning to convince these markets to use that money simply for currency interventions rather than necessarily investing in diversification away from oil. And other markets like Japan, India, for example, also quoted as having high reserves as well, and they would force them to participate in a coordinated action to bring the value of the US dollar down. That might be coming up later on. Now, this is where all of this seems to be going now. The main conclusion is, for me, they will not stop these tariffs until countries bring the gifts to the emperor and make massive concessions. And it will be done on a country-by-country basis. And this means we will see these negotiations. There will be a lot of markets back and forth, stock markets going up and down as maybe some countries are relieved of tariffs. I think the main also point is there won't be any relief regarding China. And I also think Europe will have a hard time setting up some kind of arrangement with the United States. Europe, by the way, already proposed a free trade deal even before retaliatory tariffs were announced and said, let's do 0 for 0 tariffs on industrial goods. US rejected this and then imposed a 20% import duty. Now, Europe can agree to buy more US weapons, more gas, more oil, and can reduce tariffs on certain industrial products. But US knows, I think, that Europe will not compromise easily at all, in fact, on some of its values, whether it's the new Digital Act that's controlling lies and misinformation in social media space, or Europe is trying to prevent the rise of securitization of loans, which would also be deregulation of European financial markets in the same way that US has been deregulating its own and actually creating a stage for perhaps another financial crisis. Europe will also not want to change regulations on some of the tech companies or AI regulations and so forth, and this is where the clash will probably come. Talks between the EU and US will be extremely difficult and could last for a long time. And if that ends up in a big trade war, then the whole world has a problem, because those two entities, US and Europe, are about half of global GDP. And if they economically go into recession because they're in a stubborn trade war, then everybody on the planet suffers. LATAM exports to Europe and America suffer, Asian exports suffer, Middle East, Africa, Central Eastern Europe exports also suffer. All of this means lower commodity prices as well. These are the big sticking points. I think deals will probably quickly be made with Israel, Argentina, perhaps Saudi one way or another, and UAE. India as well will make a deal. Japan, Vietnam probably will make deals fairly quickly. And this will then be portrayed in the global media saying, look, we are making deals. This is not so bad. And then maybe markets will start recovering. But do any of these Trump's policies actually make sense? Actually, when you look at some of the arguments, they say tariffs will reduce demand for imported products and increase demand for US-made products. The other argument they make, tariffs will force foreign companies to build more factories in the US, which would then increase investments and employment. The third big argument is tariffs will not raise US inflation because it is foreigners who pay tariffs and because the dollar will temporarily strengthen to tame the inflation rate. And then finally, big argument number 4 is US will make a lot of money from foreigners as they pay tariffs, which will then enable the US to cut tax without any consequences for the US budget deficit and the public debt. Now, does this make any economic sense? In fact, there is one economic inconsistency after another. So, for example, it will not be foreigners paying the extra import duties. It will be US importers who will pay and simply pass that to the final buyer, regardless whether it's B2B, B2C, or B2G. Both producer prices and actually consumer prices then must go up. And this is what the US Federal Reserve has already argued. If Trump's argument is that inflation in the US will not rise, then why would then US consumer buy more US-made products versus those that are imported? It doesn't make sense. If Trump's goal is to drive down imports into the US, so how can then US revenue from tariffs payments rise? A drop in imports would also mean fewer customs fees to collect. And if Trump wants to force foreign businesses to suddenly and quickly start manufacturing in the US, why would anyone do this, considering frequent change of opinion, uncertainty about future tariffs, and uncertainty about using US as a base for export-oriented manufacturing? And why would anyone from abroad want to invest in American factory, since anti-immigration stance will only make existing labor shortages even worse, pushing up the price of labor? And why would a shift of foreign investments from EU or Asia to US happen quickly? From decision making to actual completion of factories, it is usually 3 to 5 years, depending on the industry. So, what does all of this mean for various markets across EMEA and so forth? I mentioned a few points around Europe already. Europe, by the way, if it ends up in a trade war, it will also end up in a recession. There is no question about it. It will drag all the other Central East European markets down as well. On the plus side, energy costs are falling and oil and gas prices will fall. And this was always our forecast, as you well know, from all of our country reports and papers. But now, of course, this is being exacerbated because of the fears of the global recession. But Europe, as a big importer of oil and gas, would benefit in terms of lower oil and gas prices. Now, the other takeaways is if countries do retaliate and do not strike deals with Trump because many of the US requests might be too much for many of them, then the world is heading surely into a recession. This would push also inflation rates higher as well, because tariffs would be pro-inflationary, and this would force central banks to perhaps even hike interest rates, or maybe they will change the mind and say, well, we will ignore the inflation rate and focus on growth as they did in the aftermath of the global financial crisis or during the pandemic. Again, if the world is in a recession because of retaliations and trade wars, then in that case, commodity price falls would impact badly on Middle East, Africa markets that usually export only one, two, maybe three commodities. It would badly impact the CIS markets as well, many of whom are also exporting only a few commodities. I guess only exporters of gold would be benefiting in these circumstances, places like Uzbekistan, for example, or Tanzania, but not strategic markets for any of you. Many countries then across Middle East, Africa in particular, would be hit in a global recession by, they will be struggling to earn foreign exchange from exports. Whether these are industrial or raw material exports, there would be issues in terms of them depleting their forex reserves even more. FX shortages would then even become visible in markets where there may not be the case at the moment. There would be currency pressures, political upheavals, and difficulties servicing debt. Already, what we are seeing as of this morning is that yields on government bonds globally are rising. This is diminishing already the ability of all countries across EMEA and worldwide to service their debts. And it will make it very difficult for them to raise any new financing as well. The big impact is not only on B2G companies in government tenders, but it can be also sizable impact also for B2C and B2B as well, perhaps more indirectly. All of this feeds uncertainty and it kills confidence business-wise, consumer-wise, and surely is never good news. Europe, by the way, would also suffer from rising defense spending. The question is, how will they pay for it? If they're slowing down because of the trade wars and the global recession and manufacturing recessions, it will be more difficult for Europe to find funding for defense, and yet they would still treat it as a priority, maybe at the expense of those of you in this webinar who are selling pharmaceuticals, healthcare equipment, IT equipment into the public sector. Many of those tenders might be postponed. Same with of course, any Middle East, Africa, CE nation, especially those that are highly indebted and those that are heavily dependent on one or two commodities. They would also have a hard time running government tenders on anything, and usually government tenders would get very price sensitive with long payment delays as well. Another threat from all of this, and I will stop in a minute, is China will surely increase its commercial activities wherever it can as it loses the US market. And one part of the Trump plan is to force countries that will decide to stay in the US geopolitical fold, is to force them to also erect barriers to Chinese products. So if Europe makes a deal with the US on trade, they might be forced to increase tariff barriers on China as well, which they are leaning towards anyway. And maybe Japan will be forced to do the same. This means that China will then accelerate its commercial activities across emerging markets, across One Belt, One Road nations, across BRICS nations, which means those of you who already have a lot of Chinese competition will find that competition becoming much worse in all of the emerging markets where China has already set up sizable government-to-government deals and where they have made inroads in terms of helping with debt restructuring, building up of infrastructure and so on, where they're gaining an upper hand. To remind you, China is already the largest trading partner of 120 countries. More than 130 have signed up for the One Belt, One Road initiative. And China will play in those markets much more aggressively as it loses the US and maybe EU and Japanese markets as well. And what I think is very important, considering that there is a sell-off this morning, even or last night, even in US treasuries, which are considered a safe haven typically. This could lead to the repeat of 2008-2009 scenario, where liquidity freezes and interbank lending just stops. It's like getting a heart attack, where no bank wants to lend money to each other because trust has been broken. This is a big threat that could be a repeat of the global financial crisis of 2009. But keep in mind, all of this tariff madness is coming at the time when the global economy is already structurally weak. And I wrote about this in the October paper. If you want to look at more details, what I meant by structural weakness of the global economy, take a look at that paper from October. I'll just highlight a couple of points. It's a fragile economic structure already. The size of margin debt in global financial markets is twice of what it was in 2008. Shadow banks and private banks are acting as banks, although they're not being regulated. US again deregulated its banking system under Trump during his first term, causing some of those banking collapses. Can happen again. There has been rising securitization of US loans, similar to the pre-2009 global financial crisis. And all of this, by the way, including the persistent existence of offshore finance. And you've seen some of my papers on that in the past as well. All of this can lead to a systemic failure of some systemically important financial institution, which would then create significant problems for the entire world economy and force central banks to perhaps do exactly the same as in 2010 or 2020 in the aftermath of the global financial crisis, and also during the pandemic when they increased money printing machines, quantitative easing programs, cut interest rates to even maybe minus to try and prevent us from going into another Great Depression. But you also know what the consequence of that money printing was. A big spike in inflation in 22-23, also hurting business and the global economy as well. So, I would like to stop here and maybe just highlight for the end. I'm sorry, I wanted to say a few words. What can companies do? That's the final point. We have already seen our clients reporting scenario planning to an extent they've never done before. Contingency plans must be done on a country-by-country basis. You have to have a plan B, plan C, maybe even plan D and E, as one of our clients said recently, to address any downturns, to be making sure that you know how to protect your business if things go really bad. How do you protect your margins, your receivables, etc. So contingency planning on a country-by-country basis is more important than ever. Second, looking at optimization of any costs, automation, surely name of the game has always been there, but now perhaps even more so. And then finally, increase the control of your controllables. How can you outsmart your competition during this downturn even more? How can you increase local relevance and local resilience in markets around where you're selling? How can you become as a company more agile, more flexible when doing business? How can you get even closer to your consumers and customers during any downturns? Focus on market share as well. And cash is king, as many companies have recently said during any crisis. Focus on the cash flow, and I guess cash king is king also privately at the moment as well. Ladies and gentlemen, I will stop here. I've been speaking for, well, exactly 1 hour. And you will see the recording if you would like to hear again, if you missed a couple of points. It's a complex environment. I've been putting this paper together for you, which will be with you, as I say, on Monday. And then you will be able to go into more details and read it carefully at your own speed. Let me see if there are any questions in the Q&A box. One of the questions from a guest is which of the industries can quickly relocate their operations to 10% tariff countries like UAE from high tariff countries? Could it be garments, diamond polishing? That's one of the questions. Well, that's not easy to answer because even if countries do that, US seems to have set up a system where they will monitor and say the countries that are trying to go around our tariffs could also be punished. That was the point that I made also earlier as well. So even if countries are doing that, and particularly they have in their sight the Chinese companies that have been building factories in Mexico, Morocco, and so on, trying to avoid the duties that will be coming on China, that means other countries that have been welcoming that type of investment could be affected as well. Boyan from Bell has a question. I read somewhere that Slovakia, sorry, just moving here, questions.